Hello, everyone. Welcome to Fullstack's Financial Reporting and Forecasting Tips webinar. I'm your host, Baris Yilmaz. I'm a VCFO at Fullstack Advisory. So first things first, let's start with our disclaimer. Specific tax or legal advice should always be so pertaining to your own circumstances. This is advice general in nature. Information presented here should not be relied upon and shall not confer rights or remedies upon you or any of your employees. So who am I? My name is Baris. I am approaching the second decade mark of my career. I have been a virtual CFO at Fullstack for almost a year now. What we're doing is a lot of different things for our clients: reporting, dashboarding, modeling. We come in for a number of situations, some of which I'll be talking about during this presentation. What I've done before this was on my last in-house role, head of finance role at a fintech startup in blockchain. It's called Blockowner. Before that, I led the commercial finance division at Virtual Gaming Worlds. That was a gaming scale-up when I joined them in 2018. Now they are a multi-billion valued company. And before that, I was head of finance at Blueground, again, a tech startup, prop tech startup, during their embryonic phases. And before that, I worked at KPMG, PepsiCo, Discovery, BAT, so like a lot of listed companies and Big Four. It's a bit it's my experience is a bit like scattered across segments. Some housekeeping roles. So let's continue. So about our contents, first of all, warning, this is not a course on any of these four subjects, as it is, if you like, it's an oversimplification of a very long, arduous process of interrelated steps and spreadsheets and data sources. There's a lot going on. This is definitely not a comprehensive course in any of the following topics. It's mostly hows and whys and whats and all the questions about what we're doing, how you can apply these to your place, or how we can come in handy if you need at any one of these. So let's start with financial reporting. So what is financial reporting, right? To me, in my own words, financial reporting is just the action of presenting a company's financial information, right? So there's a set of accounting records, numbers that get formed during that process. It is, in a nutshell, how you reflect that in different POVs. So what are those different POVs? To me, again, there are two main types of it. One is the statutory reporting, mostly external, for mostly external stakeholders, and the other one is management reporting. It's, again, I say mostly because it's not necessarily, but again, stat reporting is mostly like for stakeholders like banks, shareholders, regulators, or general public. Feel like you do something according to very like strict rules or principles, and then you publish them. Whereas management reporting is much more fluid. You can change it at any time. You can just have another idea, you can have another POV, or you can remove one of the reports and stuff. So they have major differences between them. They go hand in hand. They're not mutually exclusive. What are the common outputs of financial reporting that most of you guys are already on top of it? That's like balance sheet, P&L, cash flow, and especially in the stat part, it's like statement of changes in equity. That's sometimes overlooked, but it's one of the most important reports. Directors report, auditors report, the list would continue. So we are experts in both stat and management, but this presentation is mainly about management reporting part, not the statutory reporting part. So we help a lot of customer clients to their management reporting. So dashboards, when we say dashboards, it is actually, to me, it is a main type of management reporting. So what does a dashboard entail? Dashboard is basically a management report on a visual way. So it's like it is management reporting basically, but it is more visual. So this would be your everyday management report, which does the trick. It's a very beneficial reporting system that you can tweak. You can add more tables, add more charts to this and stuff. Whereas a dashboard is, it's less of this, it's less rows, less columns, whereas more charts, more colors, more traffic lights. So however you want to present your numbers in, you'll see trends, you'll see pie charts, all of these, you'll see speedometers. So like in a dashboard, you'll see status towards a financial goal, which would be best depicted via speedometer, if you like, or you can show some trends or variances. To me, it's best shown with a line graph or a bar graph. And then you can, if you see these pie charts, they usually present breakdowns. I usually use them for expense breakdowns and all. You have a lot of options to show the view of, say, the status of the numbers in a nutshell, in a one look fashion, instead of looking at 50 different numbers. So dashboards are easy and quick to understand. They provide you at a glance of performance. As I said, like when you look at this, when you look at the bottom right part, it'll show you a trend, it'll show you a breakdown, it'll show you variances throughout time. So it's without looking at any numbers, you can have an intuitive view of what's going on. Then you can dive into the numbers. And then if you like, almost every dashboard in the latest slides will have the numbers. Then you can go back and revisit them to dive into detail. But for an eye-catching manner, this is like as good as it gets to understand how a company is doing. So they're usually device and platform agnostic. That's very important for me. That's why I always try to highlight it. Once you're tied to a platform, it's good because you are at that platform, right? But then it's not accessible from multiple devices, multiple platforms. So usually the new generation of dashboard tools and stuff, they are accessible via mobile, via any tool you can connect to stuff. And then something else that they bring to the table is multiple data sources. What that means basically is, in the traditional sense of financial reporting, you have an accounting system usually. Then from that, you jump into a spreadsheet, you take it into a spreadsheet and you tweak the results, which is good. But what these dashboarding tools usually do are they manage multiple data sources. So they connect to your accounting system, be it Xero, NetSuite, whatever you're using. And then they can get information real time from your billing system, sales, or inventory. It's like whatever you have, you can connect them into a dashboarding tool. And then you can start seeing things in real time instead of doing it once a month, once a quarter. So a good dashboard is almost real time, at least as real time as you can feed that into it. So that's a very good update of the new era of dashboarding, or new financial reporting 2.0, if you like. And I always try to warn any person about dashboards, about a few prerequisites for effectiveness. So accurate data is paramount, right? So like when your bookkeeping is not ideal, when your sales data is erroneous, when your inventory data, it's not managed by a good inventory system, or like your inventory provider is not good enough, you'll feed the dashboard with the wrong data. Then what you end up with will be very good looking charts in the wrong map. That's just garbage, right? So like, it's the first and most important rule of an effective dashboard is accurate data. And then I usually recommend a solid target or budget to compare the numbers with, because the numbers, a trend is a very good pattern. It tells you a lot. But when you compare it to an expected set of patterns, so there'll be two patterns. One is the expected one is the occurred one, observed one. Then you have an even better idea of where you're ending up. As accurate as possible. I know a budget or a target is not necessarily an easy thing for a specialist startup. But again, having something, it means you have something in mind you're trying to achieve. You have an anchor. And then timely reviews is very important, because a lot of our clients come in and say, let's meet once a quarter. It's like, to me, why do you even bother? I mean, honestly, once a quarter, a dashboard is like, you might as well just not have it. Honestly, it's 5 charts. You can do it unless you're going to make good use of it, unless you're going to use it as a decision support tool. I don't see of great value. So timely reviews are very important once your month end closes. So the very good thing about these new tools are like they're real time, right? As soon as you feed the data, you have your dashboard. So it's great. So as soon as you close your month numbers, you have your dashboard. No reason for any lag times for reporting and stuff. That's why I would absolutely recommend, as timely as possible, just sit down with your financial advisor, in-house finance person, or yourself. I don't know how financial literate you may be. Just review the numbers, take action as soon as possible. That's why you have those dashboards. And then a very important thing, again, is a dashboard needs to be catered to your needs. What this means basically is, do you have credit sales, or all your sales are based on cash or via a payment platform? Do you have inventory, or do you have any runway problems? Are you cash rich? Are you cash positive? Or do you need to know when you might be running out of cash? Or trends? Are you making revenues, or are you in the building phase? So if you're in the building phase, you're not making much revenue, but you're also more, say, like cash poor, if you like, then the runway graphs will be very relevant to you. Whereas if you're very later in the game, you're cash positive, then again, you probably scaled too big too soon. And then now you're looking at it and saying, maybe we should do some cost reduction and stuff. Then you should more look into EBITDAs, or if you're having credit sales out, days sales outstanding, days in inventory. So like a lot of different types of metrics, different types of charts might be important for you. So you should definitely sit down and cater them to your needs. You shouldn't have 25 charts in your dashboard unless you're like a $1 billion making company, honestly. 5, maximum of 10 charts should be explaining your monthly situation to you in a very concise manner. What do we do for dashboards? We're, again, tool agnostic. We have suggestions. We don't have preferred tools necessarily. We use Fathom, we use Sift, we use Spotlight, we use Tableau, Power BI, if you like. It's punchy if you're not that big. But again, we can even do good old Excel, right? I would never want to talk bad about Excel. It has its shortcomings. It's slower, obviously, but again, it's a jolly tool, if you like. It's still, you can have your dashboard in Excel, although, as I said, disclaimer, it has a lot of shortcomings. So this is financial reporting for me in a nutshell. I'll now jump onto forecasting. So what is forecasting, or what is not forecasting? So a lot of people think that I'm very good at fortune telling, and I tell them I do some financial forecasts, right? Or a lot of people think that I'm predicting future movements in the numbers by making some assumptions. Or some people think I'm just multiplying the past number with 1.05, so I'm adding 5% and creating the next number. Believe me or not, I sometimes do. That's not a bad tactic. And then some people think I'm intuitively guessing what will happen in the future. So good and bad news is that all of these are true in one way, false in another way. It's an amalgamation of all of these. To me, TLDR edition of it is narrating an assumed future state with enough business knowledge, deep business knowledge, ideally, and some financial literacy. So it's actually amalgamating the understanding of the ins and outs of a business. It's knowing the canvas and then applying a financial literacy into it. It's in the most demystified way. This is what financial forecasting is. So in the most accurate sense, I would call it forecasting is knowing the business in detail and predicting the future happenings. In the most accurate, not optimistic nor conservative. I feel like we have this misconception of conservatism principle of accounting applied a lot into forecasts. And of course, startup founders will be usually very optimistic people. So there is usually a duality between finance people and business people. I usually try to stay as accurate as possible. Don't do a moonshot. Don't be grim. Just try to reflect whatever you imagine into the numbers, roll your spreadsheet, and then see what goes on. So do it as humanly and scientifically accurate as possible. So that's what forecasting is. We'll dive into forecasting a little in our model. We have a sample model that we'll go through. So what we do, you'll understand in a way. So a budget, when you come to it, a budget is a type of forecast. So it's like people usually treat a budget as a target. Again, as I said, like to me, the ideal use of a budget is a forecast. It's not a target that will tell you what to do. It should just be your ideal or like your accurate future state that you thought it would be in the beginning of the year. So it's usually done top down or bottom up or both. So what that means basically is not rocket science. One is you have a bit to be or revenue number to be, then you make up your numbers in the granular sense to reach that bottom line. That's one way of doing it. Or else, what I prefer in companies and startup scale level are more bottom up. So I try to get more granular in the first, say, 5-6 years of a company's lifespan. So because of your numbers, you know exactly who will be working in which position or exactly how many people you want to hire. So you can make it very accurate, very granular in those phases. Of course, revenue will be the toughest to guess, but again, you'll have some ideas. A budget is usually done monthly in monthly chunks and for a 1 year period. So it's basically a 12-month forecast. And then it usually stays locked in. Once you do a budget, you usually don't touch it until the end of that year. And then you tweak the next year's budget accordingly. And it forms a very good, healthy base for your cash flow runway planning. Why? Because especially, as I said, in the granular approach, you know how much you're going to spend on where. So it's actually a good tool to plan your runway. It can form the blueprint for your cash flow needs in the medium term. Whereas, so there's also the cash flow forecasting that you start hearing more and more often. Essentially, what a cash flow forecast is, it's similar to a budget. It's another type of forecast. It's usually done weekly. Some do it monthly, but what I think is, if you're in need of a cash flow forecast on top of a budget, it means you're in need of a cash flow forecast. So it's like, if you have a budget and do a monthly cash flow forecast, it's still all right, but I think you can make it work without it. But with the cash flow forecast, I think it's better than weekly and for a 12-week period. So it's like, there is no room for anything, any guesses. You should be in a cash flow forecast. You should be very comfortable saying, I'm going to pay my PAYG installment this week, and I'm going to pay the salaries of that week, and electricity bills or rents, whatnot, 2 weeks from now. And then I'm expecting these collections at these exact dates, so that your finance person can put them in the correct chunks, and then you would know at the end of each week how solvent your business is, right? So it's like fluid. So as opposed to a budget, it's not locked in. At the end of every week, you should be rolling it forward, because the beginning cash amount will be changing for the next week. So it's more fluid as opposed to a budget. And then again, it forms an even better basis for a cash flow runway planning that'll show you how solvent your business is and how solvent it is going to be in the next 12 weeks. So for short-term cash planning, you can't beat this one. So if you compare the two, they're not substitutes. I think they're they complement each other very well. So yeah, cash flow forecast is much better for business solvents in the short run. And budget is much better for comparing the actuals and the target. So it's like, one is more of a comparison tool, the other is more of a short-term trend showing tool. And for startups and non-cash rich scale-ups, I always recommend using the two hand in hand, if possible. So much for forecasting. Again, as I said, at the end of the modeling part, we'll start showing you a financial model. Sorry, it'll sound like a cooking show, but it's like in an hour with 4 topics and a model, you just can't build it. So I have a model that I've previously built. I'm just going to go through the steps to show you what it entails. So what's financial modeling? So financial modeling is, again, to oversimplify, it's a set of spreadsheets, or one spreadsheet. Ideally, one you want to just use more tabs in order not to update multiple spreadsheets, ideally. And it combines all the things we've discussed thus far: accounting, financial reporting, metrics, KPI, dashboarding, and then forecasting. So it is basically a huge spreadsheet that combines the things that would normally be multiple spreadsheets into one, and then it becomes quite a modular way of you change very few things and all the numbers run through without you trying to tweak all of the tabs. So ideally in a financial model, you create multiple like parallel universes. I usually go with 3. You can go with as many or as few as you like. It's usually I have 3 scenarios. One is the base case always. One is a little more conservative, and the other is a little more optimistic. As I said, I try not to go with moonshots. I try not to go with absolute grim scenarios. I try to still keep them tied to the reality. Otherwise, they would just set very thick barriers, and then your base case will have nothing comparable to the other 2 scenarios. So a financial model is essentially a forecast of the future. Again, it gives you the outputs that financial reporting gives you, like a balance sheet, a P&L, a cash flow, or some graphs and charts, if you like. It is your take on how the future might be unfolding. Its uses are widespread: strategy building, fundraising. It's one of the biggest tools you use for fundraising, right? Whenever you need cash, any angel investor, any bank, any VC, any private equity firm will ask you about your model, your numbers, or your forecast, and business valuation, of course. So like it'll give you an indicative valuation of your business. It usually stems from the P&L forecast. So you usually run the P&L first, and then there are multiple ways of doing it. But as I said, we'll approach this in the most simplified sense as possible. So the most simplified version is going from P&L and then balance sheet and cash flow rolling themselves automatically. So how do you do it? So let's first jump out of this presentation and let's have a look at our model. So this is our model. So sometimes, a lot of the times, depends on your company phase stuff, you have actual data, right? In this example, we'll have 3 years worth of data, and then we have 3 years of P&L and 3 years of balance sheet. And then what we do is, so as I said, this is how I do it in terms of like mix and match. Like you can put the P&L assumptions into the same sheet, or you can put it below here and stuff to keep things tidy. I usually put the past P&Ls in different tabs and then go into another tab for P&L assumptions. And then what I do is I compare the numbers. So sorry, I actually jumped the gun a bit here. I got too excited seeing the P&L. But so like what you do is you prepare a few tabs of P&L assumptions and the balance sheet assumptions. And then after those assumptions, they'll all roll. If you look at this, you'll see that everything is actually via formulas. Even in the DS assumptions model, well, once we go through it, you'll see that pretty much everything in the model are actually formulated. So it's like you'll have very few interventions into the models after you set it up, after you make it very modular as possible. Then once you do your magic, everything should be pretty much formulated. So let's jump back into our presentation and see what we do in the P&L part. So in the P&L, so first and foremost, the revenues. So how am I going to predict revenue? So there are multiple ways of doing this. In our simplified example, it'll be historic. If you have historic data, and if you have a few years of growth, you have some numbers, and you can have a look at the average growth so far. And if you can look at the macros, economic growth, industry growth, competition, and you amalgamate a few different factors. Our industry is growing 7% on average in the last 10 years, the CAGR. And the economy is going to shrink 0.5% this year. So let's just say, consider it, let's omit that. And considering that, say 7%, 6.5, 7 would be reasonable. I don't know. So like you need to consider a lot of factors of macros, industry, your company's phase, say how much you'll invest in growth, how much you'll invest in marketing, how much your people grow stuff, then you come up with an ideal number of a revenue growth. In our case, when we jump back, I'll show that in our case it was 6 to 8 to 10. Then what I do usually is I predict COGS as a percentage of revenue. This is again, you need to come up with some management estimate here, as in how many percents of the revenue was COGS in the last few years, and how do you think you can come up with efficiencies? Is it going to stay flat? It might be. You may think that we're actually going to do a lot of cost savings in this production of whatever we're selling, then it should be decreasing and stuff. Then the operating expenses, usually this is also done as a percentage of revenue. In a startup, I favor, especially in the wages part, I like going granular. You have a list of people working. You should have a list of whom you want to hire, at least for the next 12 months. It shouldn't be like that unpredictable. Sometimes it is, I appreciate it, but sometimes it is not. As much as possible, try to go granular. Budget them one by one to see what's going on. Otherwise, if you feel like you can't do it, we're already like 3-digit people, just go with percentage of revenue. And then depreciation or amortization. Again, this is about your company. A lot of the time it's done as a percentage of revenue. So if you're just using laptops, or if you have an office and people have desks, if that's the extent of your property, plant, and equipment, I think you're much better off percentage of revenue or percentage of wages and salaries. You can tweak it because it is at the heart, it's connected to people cost. But if you think you're an asset-intense business, you have inventory, you'll buy forklifts, I don't know, you might have machinery, then you're much better off with an FA schedule. Then you'll budget your fixed asset like CapEx purchases, and then you'll come up with a schedule that will show you how much depreciation and amortization you'll have in the future, or if you're having patents and stuff. And then others, I would say should be zero. So a lot of traditional modeling, budgeting, forecasting schools uses slide buffers, right? You embed them here and there. Unless you're like a big corporate that would tell you, oh, you didn't spend your 3 million this year. Sorry, next year I'm going to cut it off your next budget. That I think that's either billion-dollar companies thing or early 21st century. I think it's outdated. Buffers are not your friend anymore. A modeling is a modeling. It's a forecast. It's not try to slide embed buffers here. Then taxes, that's basically whatever the corporate tax rate or your marginal tax rate. So it's not necessarily whatever the tax percentage is. It might depend on multiple factors, which companies, which jurisdictions you're operating at, stuff. And then basically multiplying your tax rate, your effective tax rate with your earnings before tax. So that's how you model your P&L. And let's see how we did it in our spreadsheet. So what we did basically is we had a few years worth of sales, right? They're all linked to the source tab. And then we get the variances. And if you look at the average, that's 8.5. So then you might think that, as I said, like say, with 0.5% shrinkage of macros, 8% would be an empirically good guess of a base case scenario. And then a more optimistic one would be a 10% growth. And then a more conservative scenario would be a 4% growth instead. And then what happens? What I usually do is I put a choose function here, and then you go whichever parallel universe you're choosing to be in. One is the optimistic case, right? Voila, your numbers roll themselves. So you choose which case you want to be in, and then it'll take you to the future, and it will show you what your basically revenue will be in 5 years. And then, as I said, other revenues is trivial. It's again, I usually put 0 growth for them. So it takes whatever the last one was. And then cost of goods sold, as I said, it's basically a function of revenues, and whatever the percentage was, looking at the averages again, 79, 78. So it would be a good guess. So if you can bring in some efficiencies, you can go with a few percent lower than that. Or else you might go a little chunkier and you might lose some efficiency, and then you can go into 80%. And then, as I said, the same as operating expenses, D&A, all other expenses are usually budgeted as a percentage of revenue. And then it boils down to guessing your revenues as accurately as possible, unless, as I said, you want to go more granular in the expenses. Some of the time, actually a lot of times, for the operating expenses, instead of going through a percentage of revenue approach, I just open up tabs for, say, marketing and people. And then I budget marketing and people costs very granularly, and then they flow through into this model back again. And then the rest of the OPEX, I go with percentage of revenue. Then they become a lower percentage of revenue. But again, for the trivial ones, it's easier to stick to the simplification. But as I said, whatever you can guess in a more granular manner, I would advise to have a separate tab for that. So yeah, in a nutshell, once you set this up, you have your P&L ready, and then it'll boil down to guessing your estimate in the best way possible. And then jumping back to here. What's next? The cash flow and the balance sheet. So what do you do with the cash flow? You have your sales, obviously. It's different from revenue. Sales and COGS. It's actually, in the most strict way of speaking, cash sales doesn't necessarily mean revenue, because revenue is recorded in the AASP 15 or FRIS 15 standard, so is COGS. But again, for the sake of this exercise, let's consider them the same. It washes out through time. And then loans or capital injections, they'll come into your cash flow. And the outflows will be obviously OPEX, CAPEX, or any repayments of loans or payments of dividends. And then your balance sheet, how you guess your balance sheet items. Again, we'll jump back into our spreadsheet, but for the cash, you should refer into the cash flow schedule that we talked about a minute ago. Then it'll be basically adding the cash flow, whatever the cash flow for the year results in, adding them back to the beginning cash. AR is how I usually model AR, AP, inventory, and all is like you have your days sales outstanding, or days in inventory, or days payable outstanding. They are a product of sales COGS, and you come up with a number of days. What I usually do for those is I either take the last DSO, DPO, DIO and assume flat, or you can say, I'll actually start collecting in a more diligent manner. I'll hire a collection specialist. I don't know. So my day sales outstanding will significantly reduce. So you can, again, the key here is to go with the days. Then you'll come up with whatever balance sheet item you'll end up with. Fixed asset CapEx, again, a lot of businesses just go with percentage approaches. Or again, if you're an asset intense business, just prepare an FA schedule. Just as I mentioned in wages and marketing in the OPEX section, if you think how much CapEx you'll need in the next 5 years, be my guest, that is the best approach. But if you don't, and if you don't need it, if it's trivial, just go with a percentage approach. It's much easier. And if for your financial liabilities, which usually doesn't exist for a lot of startups, unfortunately, because it's tough to get loans. But again, if you have some financial liabilities, you're much better off putting a debt schedule, just like the FA schedule. When are the cash injections? When are the repayments? What percentage of it is interest payment, and how much of it is capital principal payment? And the equity, whatever the beginning is, and then the addition of net income or deduction of net loss, and then if you pay any dividends. So let's move back into our model there to see what went on in these. So after our P&L, we jumped into the balance sheet assumptions, right? Just as I said, and your trade receivables come from the source, and then your revenues also come from the source. You see in the last years how many days your receivables were outstanding, how many days you had your inventory, and how many days you had your payable outstanding. So in this approach, I went with just assuming last year stood. I did have no extra hardships. I had no seeds that improved these days. So once you get those days, going back to your payables or going back to your receivables is simply a product of your revenues, and then how many days your revenues will stay in receivables. Then you come back to your future receivables, payables numbers. That's quite easy, I hope. And then again, as I said, for the PPE and other assets and liabilities, unless you have something that you think as a one-off that'll impact your business, or your business's core is just tying it to a variable and putting a percentage. And then, so here I averaged the last 3 years fixed assets percentages of revenue, and then went with it and then multiplied it with that year's revenue. And I came up with fixed assets, other assets, and liabilities. And then this is actually just a way I showed my P&L. Otherwise, in the P&L assumptions, I already have it. It's just a prettier presentation of the results I got in the P&L assumptions sheet, and the BS the same. Again, that's just a better presentation of it. And the cash flow. So cash flow, although it is the last you look at when you're looking at business performance, if you like, for valuation purposes, this will be the most important sheet you're looking at, because essentially valuation, as we call it in DCF. It's literally discounted cash flows. It is literally the net present value of whatever you think your business is going to bring in cash, right? Then we'll jump into when you basically look at the cash flow, it'll take you from the earnings before interest and taxes, and then you'll deduct the taxes you pay, and then you'll add back the D&A, depreciation and amortization, because it is a cost, but it's not a cost that you pay in cash. You had already paid it while purchasing the capex, so it's a non-cash expense, if you like. You add it back, then you come to one. Don't forget this one. So it's just a gross cash flow, and then you deduct the changes in inventory, receivables, and payables. You call it investments in working capital. What this means essentially is, if you have more payables at the end of the year compared to last year, it means you technically gained some leverage. You gained some extra cash because you didn't pay some suppliers. Or if you have less receivable at the end of this year, it means you technically gain some cash because you collected more. So it is the change in working capital. It gives you a plus or minus depending to your cash flow. So it's now 2. And then investments in other assets and liabilities, it's the change in other assets and liabilities. It should be close to 0 because other assets and other liabilities ideally should be close to 0. Then the capex, your purchases of whatever you purchased. That's why you added back to D&A, right? Because it was non-cash. But the capex purchase, it doesn't go to your P&L, but it is actually a cash purchase. So you need to put it there. So it's 1, 2, 3, 4. And then any other investments or extraordinary items, that should, again, ideally be 0. So then you reach into a very important variable. It's called UFCF, which is unlevered free cash flow. So this is different from your normal cash flow. Why we use unlevered free cash flow is that you actually remove every non-cash thing. You reach at free cash flow, and you remove the capital structure from the cash flow. What this means basically is, some companies have access to loans, some don't. Some companies are levered. They have a lot of loans, whatever. Some don't. Some choose to be 100% equity funded. Some are locked into it. Some can't go into anything other than 100% equity. So if you want to make the companies completely comparable, this is like making the comparison ground more equitable, more fairer for every company. So it is like making the rules of the game the same for every company. So you use unlevered free cash flow for valuation purposes. Okay? So what we did, basically, let me just take you to here. So we reached our 5 years unlevered cash flow numbers. And then we put a discount factor at the end of each year. So you have something called weighted average cost of capital. Again, I'm not going to dive into the most technical details of evaluation, but what WACC basically is, it changes from company to company. It changes according to industry. It changes according to the buyer's POV. So it's like, it is whatever a purchaser of a company, if you like, or anything, expects returns from that company. So it's what the purchaser wants to make out of this potential purchase, if you like. And then the G is the universal growth factor. It's like perpetual growth factor that will give us the continuing value, if you like. So what you basically do is all the things we've discussed so far, you've come to the unlevered free cash flow at the end of these 5 years, and then you discounted them with your WACC and the discounting factor. And then what you came up to is your present value cash flow. So it's not much, but it's fair. You think that at the end of these 5 years, the company will bring in 50K-ish. I mean, obviously it'll bring more, but it's like the present value of those numbers will be like 50K plus-ish. And then the company's continuing value will be whatever the last USCF is, and it's the product of it with the WACC and the growth factor. And then the combination of the two will give you the enterprise value. So this is, in a nutshell, how you do a DCF valuation. And then we're running out of time. I'm going to wrap it up in a minute or two. And then, yeah, I usually do a sensitivity analysis here with tweak the WACC, tweak the G a bit, so that the reader of this DCF model can see, had it not been 10 but 11 WACC, what would have happened? So to show it in a better way, I just prepare a simple table there. So that's, in a nutshell, how a DCF valuation is done. And then let's jump back into our yes. So how you can do a valuation, you have a lot of methods. I usually, for my startups clients, I usually do a DCF, a Berkus method, which is getting outdated, but it's entertaining. That's why I still keep it there, and a scorecard method. So the DCF, as we discussed, and the Berkus method, because he was a legend investor, actually. He just put 500K to each chunk that he thought about the management team, the technology, or is there an MVP, or is there an existing market? Is it already revenue making? How the business model is working, and if there are any secret sources, strategic relationships and stuff. So he put 500K to each chunk, and then he gave a rating to each chunk. Then he said like, oh, I think this company is worth 1.2 million USDs. It's usually like $500,000 USD for each chunk, and then you come up with something. As I said, it's extremely intuitive, has very low connection to real valuation. But after all, I always say the value is in the eye of the beholder. It is, I mean, they'll invest in you and your idea, not necessarily for the model. You're just backing it up usually. Then again, scorecard method is something in between. What you do is actually similar to Berkus method, and you'll have 6 chunks, and then you'll give them some weights, which should add up to hundreds, and then you'll give a relative impact, say at a maximum of 100%. Then you multiply them, then you come up with a quotient, and then you multiply it with the average recent transactions in a comparable industry, and then you come up with a valuation. So these are all different types, methods of valuations we do for our clients. As I said, there's no one secret golden solution, but I usually go with these 3, DCF being as high as possible in terms of priority, and then the rest are just like more backups. So this is the end of my presentation. Wishing you guys all a great rest of your day. If you have any other questions, just send us a message, find us on LinkedIn, send us an email, and have a good day.